It has been a constant endeavor to present to you the thought leaders in the global space, and it is with great privilege that I introduce to you our guest for the day, Callum Thomas, a man we have thoroughly learned from all these years. Little is more when it comes to his introduction. He has seamlessly switched gears from being an investment strategist at a leading bank to finding his very own company, Top-Down Charts, creating insightful and very actionable research. His Twitter following speaks volumes about his work, which is clear, concise, and yet very insightful. In fact, we have been lucky enough to pick up some very early trends owing to the in-depth charts that he has shared across platforms. Thank you, Callum, for sharing your knowledge and for giving us a privilege to host you today.
Absolutely, it's a pleasure.
Callum, before we start getting investment ideas from you, I have been seeing you track thousands of indicators and effectively so. So how do you structure your time so that nothing misses your eye?
That's a good question. I think probably some of it's a little bit unconscious, or I sort of just through the sort of process of going about my day, I absorb various things. I guess on Twitter, sometimes looking at the home feed, I follow a lot of people, and I try to increase the probability of something interesting showing up on the home feed. But other than that, I produce a weekly report on Mondays, which is basically global markets, sentiment, positioning, and part of that is just to kind of flag, well, see if there's anything that's worth looking at a little bit closer, seeing if there's any markets that are standing out. I tend to sort of, I'll look at a chart and I might not say, all right, there's something there, but it might sort of sit in the back of my mind, and then later in the week I'll be looking at something else and the connection will be made. Then I'll dig deeper, and then of course at the end of the week I do a different report, which is a lot more in depth, a lot more holistic view, and just the process of having to come up with 5 different ideas for that every week kind of forces you to be thinking. So there's sort of those unconscious methods, there's the systematic scanning of the markets, and then the stuff that happens in between.
It's a constant hunt for research that gives you more research content, I believe. Okay, interesting one there. And now addressing the big elephant in the room, what do you make of Fed's stance? I think it has recognized growth really well. It has also said that their objectives can now be met than was previously expected. So where do you see the monetary policies of the globe in, let's say, next 1 year?
I think this was one of the things that I really got onto early last year, was the big global pivot to easing, the big tidal wave of stimulus that we saw last year. That was, I was quite early to pick up on that. And I think this year I'm equally early in picking up on the emerging wave of tightening that we're seeing. So I just counted this morning the number of rate hikes across the world so far this year is actually 23. So it's mostly very small countries, developing countries, certain emerging markets, but those are the ones that are most sensitive to inflation, and those are the ones that tend to both start hiking early but also start cutting rates earlier. So that's why I think it's good to, normally we wouldn't probably look that closely at those sort of countries, but as a sort of leading indicator, I think it's quite an important group. And I guess how that feeds back to the Fed is that if we look at what happened last year, yes, the Fed is arguably the most important central bank, but the way that every central bank basically got involved, and you saw a proliferation, a big spreading of quantitative easing being adopted by all sorts of countries that had never considered it before, massive rate cuts across every country, that it's basically the Fed's not the only player, and I think that because it was so coordinated and resolute, it had far greater impact than if it was just the Fed, for instance. So I think what we'll start to see is more and more countries stepping slowly away from easing, and into tightening. And I think the Fed is, it's just going to be part of that trend. Probably start tapering in the next few months, or at least flag the tapering, talk about tapering. That's the talk about talking that they were on about. And I think that if things continue to unfold the way that they're unfolding at the moment, we probably see a chance of rate hikes next year by the Fed. But a lot of that comes back to a few pretty key assumptions. So one is that people get enough vaccinations that we see an effective stop to the pandemic, enough that the global economy can effectively reopen. Number two is that we see continued flow through of all that stimulus that's been poured into the system, because there is some lags to the way that between cutting interest rates and the full effect of that flowing through, and also fiscal policy spending. So, for instance, Japan, Europe, the US have got large fiscal stimulus programs still underway, and so those are still going to be having an impact over the coming quarters. And so you have reopening, massive stimulus, and then also I think that we're probably going to see an element of a relief euphoria as people, this sort of like, it's finally over, we can get back to normal, let's go crazy. Especially when they notice that their bank accounts, in many instances, not all instances, because there's winners and losers, but if you look at the savings, that the statistics show that in aggregate, the savings have increased quite a lot. So arguably some element of pent-up demand. We could see a lot more follow through in the growth that we've seen, because we've already seen a rebound. And so the question is, what happens next? Does it rebound up and then down, or do we rebound and have a sustained period of strong growth that ultimately leads to higher inflation?
Sure. So now that we're expecting some form of tapering and hikes, etc., to come in, what do you think the equity markets prefer? Do they want full-fledged growth but a monetary policy rollback, or would they want, a mediocre recovery but a policy support to stay in? What benefits the markets most?
It probably depends a little bit what sector we're talking about. So I guess, well, first of all, I guess what do those two scenarios look like? One would be where bond yields basically stay relatively low, and where growth is good enough to keep earnings growth kind of stable. And that would be probably, I guess, a not too hot, not too cold scenario for equities. If in the latter, where if we get bond yields rising significantly or sharply, then you get a squeeze in the equity risk premium, and basically the valuation of equities to bonds. And if we look back at 2018, that provides a pretty good analog for what happens if bond yields rise too quickly. That ends up reducing the favorability of equities versus bonds. And then, if we look back at that period, you got a pretty significant correction in the S&P 500. And, in terms of sectors, that's probably going to be mostly expressed in the tech sector, where valuations are quite significantly elevated versus history. And also, one of the things that I've been pointing out is that if you think about the US tech sector, it actually was one of the winners of the pandemic. So, they got a a dividend, like a one-off growth boost, because all these trends that were kind of already in place, like working from home, Netflix, moving more towards flexible working. All of this got immediately brought forward, and it's really hard to replicate that kind of growth going forward. So I think the way that tech stocks ran up was probably rational in that it reflected that one-off boost, but then at least tapering off for tech stocks would be my base case there. So I think then we need to go back to what else is happening in that scenario. If it's a scenario where commodities are doing well, where the economy is doing well, where inflation is running at a decent pace, real activity is picking up, then it's probably going to be the old cyclical sectors. So technology used to be, well, most people I think would call technology a cyclical sector, but in my view, you put it in a different bucket, and for what I call them old cyclicals, so energy, financials, industrials, materials. So these are the sectors that benefit from actual activity, from shipping, from mining, from building factories, making things. And in that kind of scenario where the world is reopened, activity is booming, it's those sectors that are going to benefit probably disproportionately versus tech. And so that actually has quite a significant impact on how you think about value versus growth, because value is more tilted to old cyclicals, growth is more tilted to tech. Also global versus US. So if you look at global equities excluding US, it's about 50% weighting to old cyclicals, whereas the US is almost half of that, around 20 to 30%. So in that respect, I think it's, that is basically my base case scenario. So I think that for me, that definitely colors how I look at the world. And then, as a coincidence, value looks cheap, very cheap versus growth, and global looks cheap versus US. So that's pretty good summary of how I'm thinking about global equities at the moment.
The global looks better than US. Very well point taken there. Now, what do you think of, do you have some take on emerging markets versus developed markets as a whole? Are you developing a view around the dollar index per se, as in when the, DXY moving, as in when the policy stance changes and, tapering starts? Could DXY shoot up, or for inherent fundamental reasons, it should hover around current levels or maybe inch lower?
Yeah, I'm still happy to hold a medium-term bearish bias for the US dollar. A few things going on there that I'm paying attention to. So yield support has been fading from previously quite significant levels. Valuation has actually gone down to neutral. It was previously overvalued, but the usual pattern is that you see valuation overshoot. In terms of the technicals, longer term cycles, it looks like we're in, towards the end of another one of those longer term cycles. For the DXY tends to go for these about decade-long cycles. And then also on the technicals, the DXY broke its medium-term uptrend line, and it still hasn't even retested that. So for me, that's a pretty good setup. And then also the fiscal outlook for US is still on a deteriorating path. And then I think also if we look at rest of the world, arguably the rest of the world has more to surprise to the upside. I think the US has kind of been quite advanced or quite at the front of the recovery and the reopening. And if the rest of the world catches up, that kind of puts a little bit of extra boost there. I think also the stronger performance that we've seen from commodities and emerging markets, you can tend to see a bit of a self-reinforcing cycle where a weaker dollar helps emerging markets and commodities. and then because emerging markets and commodities do well, then investors pile in, and then that weakens the dollar a little bit more, and then you sort of get a virtuous cycle there, which can also operate in reverse, which we've seen a few times. So I think I'm happy to remain bearish US dollar medium term. In the short term, it looks like it's bounced off that support level, and yeah, I mean, from a tactical standpoint, to have full conviction on the bearish side, you would want to see the DXY break down through that key support level there. Also, positioning and sentiment is still quite bearish on the US dollar, so it's still it did have a small reset, but still for the most part quite crowded on the bearish side. So you know, it's not necessarily a barrier to the US dollar going lower, but when everybody is on one side of the boat, it doesn't take much to move to rock the boat, so to say. So that's
on the US dollar is what you're saying, which is very well fitting in the current context of things as well. Now, where do you see those commodity cycles? And I'm coming from there are two camps. One saying it's just transient and it's not a demand supply balance. The other camp is talking of a commodity bull run be a multi-year super cycle that we are in. Which camp do you think you are in? Do you think this is a sustained one-way trend, or do you think this is more of a demand supply mismatch? And secondly, continuing on the commodities, again, there are two camps that if China's demand is down, or if China's credit impulse is not doing so well, then commodities cannot sustain this bull run. But there's also another camp which says it's not China this time. It's a combination of rest of the world, which could in fact create a solid demand, and commodities up move could continue. So what is your take on these?
I think, well, kind of the answer that springs to mind is that, you know, they can both be right, that we can have a sustained upward trend that actually has a few cycles around it, which is most often the case. And I guess also if we look back to recent history, the start of the most recent secular bull market in the 2000s, there was an initial very strong rally, which was followed by another cyclical bear before the big, really big run got underway. So I guess that's one cautionary that the answer probably can, well, the answer definitely can be both, and that's one example of you know, both being right. But what I'm paying attention to on the secular, or at least the you know, whether or not it's a decade long, but whether or not it has fundamental support to go further, and whether that's, you know, a couple of years versus 10 years, it's we'll have to wait and see. But what I'm paying attention to is CapEx, so capital expenditure by commodity producers. So I look at one indicator I look at is the CapEx, capital expenditure to assets ratio, so just standardizing it. And that fell very significantly during the secular bear market for commodities and had actually started to recover. But then, of course, 2020 happened and commodity CapEx collapsed, actually went to the lowest on record. And so I think, you know, given that the supply situation had already begun to correct, and then you have this big reset that happened last year, that was a mix of factors. So one, commodities fell, so it's always harder to justify a new investment if commodity prices are falling. There was an initial credit crunch, so very hard for commodity producers to get funding and very high costs. And then just the uncertainty factor, but also the other really big theme at the moment, that disruption, supply chain disruption, logistics, shortages, all of that really getting in the way of, you know, whether it's digging holes or drilling wells, really throwing a spanner in the works there. But I think, and one other thing that I'm and I don't know how big of an issue it will be, but the greater environmental consciousness that's definitely spreading across investors. You know, the investors I speak to a lot of them are starting to factor in ESG or even creating ESG products. But also socially, I think there is a greater awareness of the environmental impact, and that we might actually see that starting to constrain what can actually happen on the capital side, the investment in new supply of commodities, whether that's a slowing down, an outright no for doing certain types of projects, or just increased funding costs, which make it not as economical as it might have used to have been. And so I think that constraining supply growth like that is definitely something that would support the case for a multi-year run in commodities, or further upside. And then on the demand side of things, also on the environmental front, is electronic vehicles. So, like for instance, in New Zealand, there's a big push to increase adoption of electronic vehicles. There's subsidies, there's investment in infrastructure. And I know that a lot of other countries are starting to push this as well, and also other forms of climate-related investment. So if we look at Europe's fiscal stimulus plan, I think almost a third of that is going to environmental-related or climate-related investments. So, if we did have this big mass worldwide adoption of electronic vehicles, of investment aimed at producing better outcomes on the environmental front, that's quite a significant demand for all commodities. Paradoxically, a greater adoption of electronic vehicles in the short term is going to mean greater consumption of fossil fuels, because we need to move all this stuff around, and there's a lot of energy that's involved in actually making them. So I think if we wanted to think about how the supply and demand, or a supply and demand scenario that would support that case, that would be my best guess. In terms of how China plays into it, you're absolutely right. We've seen the China credit impulse turnover actually went negative. And historically, that's had a pretty good link to both global growth and commodities. I'm in the camp that says this time it may not matter as much, because, as we discussed earlier, the rest of the world turned their economy off, poured a whole bunch of stimulus on, and then is about to turn their economy back on. So it's unlike anything that we've seen in the last, well, I don't know if we've seen it in any time in history, and we definitely haven't seen it during the time that we've been looking at the credit impulse. So it's by its nature, it's unknowable, but my best guess would be that the rest of the world can offset any excessive slowing by China. And at the same time, though, I don't think China is setting out to try and slow their economy down too much either, because they've still got to manage the situation there. So I think shorter term, everybody's bullish commodities, so that does make it a little bit of an issue. Again, positioning sentiment is very bullish, and that can create the preconditions for a correction, which is why, again, we could have that cycle around an uptrend. So hence why I said both.
Medium term, you are all in for DXY weakness as well as commodity upswing. Anything specific in commodities that you are watching? Do you have a preference of metals over soft commodities, or you think a basket allocation would help here? Any thoughts there?
Yeah, well, most of what I just said there, I'm thinking in terms of commodities as a basket. So, for instance, the GSCI, I think it's Bloomberg light energy index, so it's quite a diversified index of commodities. But there's a few different indexes that have a fairly equal weight, which is probably what I would lean towards.
Okay.
Because yeah, I mean, yeah, there's some tactical views that we can have with specific commodities, but I think in terms of the larger theme, it's a basket.
Sure. And I'm going to make you switch gears from commodities to real estate, housing, etc. Now, US, I think there was a very interesting chart that, Michigan housing sentiment indicator has fallen and rental yields have not risen, but asset prices in real estate are way up. So what do you make of this picture? Are we entering another bubble that might burst soon? Or real estate buoyancy is here to stick around? I mean, we are seeing the similar buoyancy even in a country like India, for that matter. So is that a global trend, upswing in housing prices that is here to stay? Or is the best behind us already?
I think, yes, we've definitely seen it globally, definitely seen it in New Zealand as well, and increasingly Australia. But yeah, most countries I look at, and it would make sense because typically what you see in the housing market is if you reduce borrowing costs, you've basically increased the amount that people can afford to pay, and sooner or later that works its way into higher prices. The immediate impact of that is definitely has worked its way through. I guess the other aspects would be that with people not traveling, spending a little bit less on retail, dining out, holidays, that gave them extra deposits. So it also gave them a boost to what they could spend. In some countries, they eased up a little bit on the standards by which they make the loans as well. But pretty much a perfect mix of ingredients to get a spike in housing prices. And then I think also there's probably an element of people being reluctant to move, given that there's uncertainties. You don't want to put your house on the market and then have the quarantine disrupt the whole process. So there's definitely been a shortage of listings in the US and certainly over this part of the world as well. In terms of where it goes, well, if we look at developed economies, the housing valuation indicators, they were already quite high before this, and absolutely valuations for the housing markets have gone up quite significantly, as you would expect. So yeah, usually expensive property markets don't just collapse in on themselves. They need something to kind of stop them from going up, which is basically would be the reverse of that. So if bond yields, interest rates really started going up quickly, then that would definitely slow that down, whether or not it triggers any risks. I do know that when I last looked at it, leverage in the US, so household borrowing it's a little bit lower than it was during the previous housing boom. So maybe there is some, a little bit of lessons learned there. Over this side of the world, there's been macro-prudential measures which have kind of meant that rather than a straight up and down, it's sort of been a sustained rise. So I think as long as interest rates stay low, then it probably can go further. But yeah, if interest rates started going up sharply, then that definitely will at least put a stop to rising prices.
Sure. So moving on quickly from here, I think credit spreads are down. High yielding bonds in US technically have a negative real rates now, given where the inflation readings are. US, for that matter, had a 40-year, I think, downward trend in yields. Any reversions that you see now on, or do you think anything below 2 will be a comfortable level where US yields will stagnate for good or for foreseeable future?
Well, if I start with that view that I was talking about at the start, with this picture where the global economy reopens, has large stimulus, inflation overshoots, and then I look at a couple of indicators that I'm watching quite closely. So I have a market model or macro market model where I look at about a dozen different indicators and how they relate to the US Treasury yields. And they're pointing to the US 10-year yield. If you took it literally, it would say that it should be closer to 3%, or at least in the high 2s. And if I look at the valuation indicators that I run for treasuries, they're still quite overvalued. So, maybe it's not straight up, and maybe it is a bit of ranging first. I think it's fairly straightforward to make a case that US 10-year bond yields head up towards 2% and possibly higher.
Sure. So now where we stand, probably bonds are not going to give us so much returns, either equity. Anyway, we've seen some form of consolidation that might come in. Where would you put your money, given that you look at so many asset classes? If you were to do an asset allocation today, what would be ideal at this point?
Yep. So thinking on a sort of medium-term time frame, so 3 to 5 years, definitely commodities. I think still some bonds, because even though bonds look like they're going to deliver negative real returns over the longer term, in the short term they still do act as a diversifier. So if even though I tried to make my best guess, it was wrong and everything goes bad again, then at least bonds will probably still rally. And also some cash for the same reasons. Equities, I think it's being a bit more nuanced. So very light on US, or if you have US, it's more in the old cyclicals or the value sectors, more in global. Within emerging markets, like emerging excluding Asia, so LATAM, East Europe, Africa, Middle East, significant relative valuation case there, and also a strong linkage with commodities, and also they've been beaten down quite a bit and starting to turn the corner. That would be the sort of the high level view there, and then also probably reducing exposure to US dollar.
Sure. So that's a great asset allocation mix. I think it helps investors to diversify and also, I think, maximize on the returns there. Very insightful conversation, Callum. Thank you for joining us today.
It was a pleasure.